Welcome to this explainer. Look, if you've been paying any attention at all to the housing market lately, or frankly, just looking at your own monthly budget, you already know that things feel a bit disconnected. Today, we're going to dig into the American mortgage trap, and we're actually going to trace its roots all the way across the globe. So, I want to start by asking you a really direct question. Whether you're hunting for a new home, saving up for your very first one, or you're already a homeowner waiting for a chance to refinance, who do you actually think dictates your monthly house payments? When those rates go up or down, who is the entity turning the dials behind the curtain? If you're like 99% of people out there, you're probably thinking, well, the Federal Reserve, obviously. I mean, it's what we read in the headlines, right? We wait on the edge of our seats for their meetings, we watch the press conferences, and we just assume that whatever the chairman of the Fed decides is exactly what our local bank is going to charge us for a 30-year fixed mortgage. But what if I told you that common wisdom is actually totally wrong? Section 1, the Jerome Powell myth. Okay, let's dive into this and completely dismantle the belief that Jerome Powell and the Fed are the absolute masters of your mortgage. Here is the massive economic plot twist that completely shatters the paradigm we've all been operating under. You've been told over and over that the Fed controls interest rates. And they do, some of them. But your specific mortgage, the rate you actually lock in to buy a house in Ohio or Texas or California, that is actually being decided all the way over in Tokyo. I know, it sounds wild, but it's the absolute reality of how our financial wiring actually works today. Section 2, short rates versus long yields. To really understand this Tokyo reveal, we first need to break down the mechanics of how interest rates actually function under the hood. This brilliantly illustrates the strict boundaries of U.S. monetary policy. Think about short-term rates. This is the Federal Reserve's actual domain. When you hear about the Fed cutting or hiking rates, they're dealing with the short-term stuff, like the rates banks use to lend to each other overnight. But then we have long-term yields, which is exactly where a 30-year mortgage lives. Long-term yields are completely driven by the invisible hand of the market, global supply and demand. The Fed doesn't just get to push a button and set the price of a 30-year loan. The global market does. And man, this is exactly why it's so incredibly frustrating for everyday Americans right now. You turn on the news, you hear the Fed is cutting rates, and you naturally think, awesome, my mortgage is about to get cheaper. But then you call your broker and the rate hasn't budged, or worse, it literally went up. Why? Because the Fed is pulling a lever on short-term rates, but your mortgage is tied to long-term yields, and those are marching to the beat of an entirely different drum. Section 3, the Tokyo connection. So what exactly is that different drum? Let's transition across the Pacific and introduce the real main character of our financial story. Which begs the question, what does a country over 5,000 miles away have to do with the cost of your 3-bedroom suburban home? It's a great question. And to answer it, we have to look at a specific financial instrument that almost nobody talks about outside of Wall Street. It all comes down to Japanese government bonds. These are the quiet, unassuming financial instruments that everyday Americans unknowingly rely upon. While we're all staring at the U.S. Federal Reserve, global investors are staring intently at the yield on Japanese government bonds. Because what happens with these specific bonds ripples out and essentially dictates the terms for everything else on the planet, including your mortgage. Section 4, the global duct tape. Now, what's really interesting about this concept is the metaphor used to describe it. The source material gives us this brilliant, tangible definition. Think of Japanese government bonds as global duct tape. For a very long time, Japan kept their interest rates incredibly low. Because the rates were so low, global investors would borrow money there on the cheap and then go invest it everywhere else in the world to get a better return, and that includes buying U.S. mortgage debt. Those Japanese government bonds acted as the structural adhesive, literally the duct tape, holding the whole global financial system together, keeping liquidity flowing, and keeping borrowing costs globally, and for you, relatively low. So, the crucial point is understanding the exact chain reaction when that duct tape starts to lose its grip. Let's walk through it. Step 1, Japanese interest rates start to rise. Suddenly, borrowing there isn't so cheap anymore, and Japanese investors want to keep their money at home. Step 2, because that money is staying home or costing more, global bond yields shift dramatically. The supply and demand mechanics we talked about earlier go into overdrive. There's way less demand for U.S. debt from overseas. And step 3, because of that massive shift in global supply and demand, U.S. mortgage rates stay stubbornly high. Section 5, your mortgage reality. Let's bring this entire macroeconomic journey all the way back home, right to your living room and your monthly budget. This is the ultimate crucial takeaway of this entire explainer. You have got to separate the headlines from the actual mechanics. As long as Japanese rates are rising and shifting that global supply and demand for long-term yields, U.S. mortgages are going to feel that upward pressure. It happens completely regardless of what Jerome Powell and the Federal Reserve are doing with their short-term rate cuts. Until the structural duct tape in Japan shifts back, the Fed's scissors simply cannot cut your mortgage rate. Kind of makes you look at the world differently, doesn't it? We really like to think our local economies are just that, local. But we are deeply, inextricably tied to the financial currents on the totally opposite side of the planet, which leaves us with one final, very important question to think about long after we wrap up today. If Tokyo's bond market is secretly setting the cost of your American mortgage, who else in the world is quietly pulling the strings on the rest of your wallet?